Hello and welcome. You're watching BTVI. Welcome to this special edition of Markets in Samva 2074 Commodities Special. I'm Pranay Banerjee. And if you take a look at the commodity universe, it's been quite a sharp run-up that we've seen, at least in industrial metal prices. Case in point, copper has gone up over 40%. There's aluminium that has seen strong gains of around 24% and zinc has scaled up over 30% as well from last Diwali to this Diwali. So the base metals pack has clearly been the star of the year. Apart from that, we've seen crude oil that has spurted up almost 17% thanks to the kind of big spurts that we saw towards the end of November, thanks to the compliance agreement that was struck between OPEC and non-OPEC nations. Apart from that, we've seen gold that has remained mostly flattish, and of course, it has been a victim of the stop-start nature of risk on and risk off that we've seen between the situation play out between the US and North Korea more recently. And as far as natural gas is concerned, that's been a little under pressure, down around 1%. But to decode how the trend has been in this year, what cues to take forward for the next year as well, and where do these gentlemen see commodities levels for the next Diwali, we've got an distinguished panel joining us. We've got Navneet Damani, Associate VP and Head of Research at Motilal Oswal Commodities, who joins us in the studio. And we've got Mr. Vijay Bamwani, who's author, and he's also CEO of BSPLindia.com. Thank you so much, gentlemen, for joining us in the studios and sparing the time for being with us. Vijay, let me start with you first. I mean, let's start with crude oil and the energy markets overall. We've seen a lot of trigger points, and the most important one being the end of November. We saw that compliance agreement come through. And as you were saying just before the show, one seminal change possibly is Saudi speaking with and engaging with Russia in a more concrete and meaningful way. Does that give you any sign of this agreement going beyond March of 2018 and thereby some more upside to come through?
Thank you for having me on your show, Pranay. And I do agree completely with you that there are tectonic shifts slowly but surely being witnessed in the energy markets, in the hydrocarbon space. Now, if you go beyond the golden escalator of King Salman being the center point in his Russian visit, it's noteworthy that the world's largest exporter of hydrocarbons, which is Saudi Arabia, the sovereign, the king visiting the second largest exporter of oil and gas in Russia personally. It's completely, it's actually impossible that there not be any kind of agreement between the two to manage prices. And prices need to be managed upwards from both the Russian and the Saudi point of view. The Saudis would want higher crude oil prices to tackle their rising fiscal deficit, as well as ensure a good response to the Saudi Aramco. So far, the largest IPO in the world, approximately $100 billion US, slated for next year. The Russians are under pressure to raise their revenues because of trade embargoes after their attack in Crimea and Ukraine. So both the parties are similarly vested in their interests to see crude oil prices higher. So would be all the other OPEC nations. So I do feel possibly the lows that you saw on crude in 2016-17 should be the worst behind us as far as rally in crude oil prices is concerned.
Navneet, do you concur? Do you believe that the lows that we've made in this year are possibly the lows that we've made for good? But do you also believe that scaling a $60 per barrel level would be a tough ask in the medium term?
Well, Pranay, I would agree to a point that yes, the lows have been tested and probably done away with. So 2015-16 were the lows that we saw, $26 coming for the crude oil prices, and this year we've seen average crude oil prices in the range of $42, $43. So in my sense, we've seen that bottom is done in place, but rallies from here on will not be very significant. There will be consistent uptick in crude oil prices. Probably dips could be used as opportunities to enter long position. As Mr. Bambani mentioned, that there's a structural shift in the crude oil pricing or the market which is happening. And probably the Saudi Arabia IPO which is coming in is the biggest thing that could impact the crude oil prices or probably give some kind of consistency to the prices. So any major dips, in my sense, could be opportunities for entering into the long side. Opportunities, I see prices in the range of about 8 to 10% upside from here on, but however, scaling above that could be a little difficult, talking about today's condition and prices.
Mr. Mambani, there's also another element here, which is of US shale gas and shale oil. As you were saying earlier as well, possibly it's a win-win situation for all parties here involved, all stakeholders involved, to allow prices to at least scale 60 for the sake of remunerations and for the sake of their own GDPs. What do you think about the US and the kind of supply-demand dynamics that they are contributing to? Now we've seen IOC, BPCL also starting to contract shipments, although not in a very big way, but it's a seminal move in and as of itself. When do you see them reaching a 10 million barrel sort of a level? And do you think that this environment globally is good for everyone to allow prices to go higher?
I would think so, yes, Pranoy. There was this huge shift in US drilling and oil exploration policy after the Arab oil embargo in 1973. The US clearly realized how swiftly oil prices can upset their economy. So there's been a conscious effort to not dig into their own reserves and save them for the last. In 2017, the US has now started exporting crude oil. By 2018, they aim to be the net exporter of crude oil. So far, crude was clamoring, US was clamoring for lower crude oil prices. Now the same guys are going to be clamoring for higher crude oil prices to receive better export income. So even though the Saudis are now shifting towards the Russians, the S-400 missile systems deal between Saudi Arabia buying from the Russians is an indicator of that. So I have a feeling, in spite of the US allowing the Russians to encroach into their armaments industry, they would be secretly overjoyed that the Saudis and the Russians are pushing crude oil prices higher because American export income of hydrocarbons would shoot up, therefore.
Right. We've also seen one very interesting thing, and this is obviously also owing to the kind of hurricane season that we've seen in the US, that not only have crack spreads seasonally gone up, I mean, there have been spurts, which has been good for regional refiners, but also the spread between Brent and WTI has become a whopping $6 to $7 per barrel, which on an average was around 2 to 3. I mean, correct me if I'm wrong, if memory serves me right. This closed down to parity when the US oil embargo lifted in the December of 2015. But after that, we saw it normalizing again to $2 to $3 per barrel. Now it's at 6 to 7. Do you see it normalizing anytime soon to a range of $2 to $3 per barrel?
2015 was a different point altogether. Prices were cracking very significantly, and that's what led to the parity in the prices which we were talking about. But in my sense, this difference about $2 to $3 has always persisted. Earlier, you used to count it in percentages when it was about 100, 110 to the dollar, and now it's pretty obvious because it's about $10, $12 premium to what Brent is at the moment. So WTI generally trades at a discount. Yes, we saw the discount widening after the hurricane season, which led to back-to-back hurricanes and storm warnings, and all these led to a very sharp decline in WTI prices, but Brent did not react much to the prices. In my sense, gradually this would converge, but $2 to $3 is the premium that is always going to stay for the next at least 3 to 6 months or so.
Mr. Bambani, what do you think about the compliance agreement? 32.5 million barrels at the headline level. They have given indications of slipping a bit, but mostly we've seen that it has been adhered to. And of course, the biggest producer in that cartel has motivation to maintain its compliance level. But on the margin, do you think that countries like Libya as well as Nigeria, although on a very low base, but the production has spurted very sharply, and countries like Nigeria were at least nudged in the Turkey meeting to make some quote-unquote adjustments once they reach a 1.8 million barrel sort of a level. So your thoughts on the same?
Pranay, the OPEC cartel, or the conglomerate itself, is a very complex kind of an institution. Crude oil quotas are allocated based on claimed reserves rather than established reserves. So it is in the interest of every exporting country which is a part of OPEC to ramp up or pad up their claimed reserves. Now, obviously, all these guys are facing some kind of a financial crunch because of falling crude oil prices in the last 3 years. So they would rather breach this quota or compliance agreement on the sly, and in the oil market, it's politics, it's geopolitics, it's terror, it's financial premium, it's marginal cost versus extraction cost, etc. Many such equations do get factored in. So what you see is true. but what you also don't see also happens to be true. So while net at least till the Saudi Aramco IPO is not done and dusted with, I do feel compliance levels would be a little more higher compared to the long period average. But once this is done, I think guys like Iran and Libya and all will start pumping higher.
And also about market share, do you believe that Saudi Arabia, owing to its market leadership itself, I mean, that is coming back to hurt them in terms of losing incremental market share because of the strict adherence to the compliance agreement in maybe markets like China, in maybe India, and even Europe for that matter?
Well, it's a kind of situation, damned if I do and damned if I don't for the Saudis. If they don't sell more, their budget is getting crimped. Now, they have huge expansion plans at the supergiant oil well at Gawar. They need to build bigger and better gas oil separation plants. They need enhanced oil recovery to be immediately implemented so as to raise the pressure at the oil head level. All this costs money. So to that extent, the Saudis cannot really lose their market share. Even if prices were to go higher, my guess is the Saudis will continue to supply the markets adequately. And ironically, what happened yesterday, the Chinese making a counter offer to the Saudis not to come out with an IPO of Saudi Aramco because the Chinese are willing to buy 5% stake from the Saudis directly off market in exchange for 100 billion US dollars. I think this is a major development at all.
So that, I mean, we can go on talking about crude oil and the interesting dynamics there, but let's shift focus also to precious metals. Now, why this pocket has been interesting, Mr. Bambani as well as Navneet, is because the recent commentary that we've heard and dialogue between US and North Korea, that has led to a stop-start nature of a rally on gold. I was just tracking certain levels. On the 15th of December 2016, we were at $1123 an ounce on gold on the COMEX. On the 8th of September, very recently, we were at 1362. So we've seen a very volatile move within a short span of time, possibly only 9 to 10 months on gold. And broadly, over the last few months, we've remained bounded at 1200 on the lower side and 1362, but mostly 1300 on the higher side. What's the view on gold from here on? Let me start with you, Navneet, because we've had the exchange rate also play a part in it. I mean, post demonetization, immediately we slipped to 68.5. Then we strengthened inordinately, and lately we've just weakened a little. So we are close to around 64.5. What's the view on gold? What would probably your 6-month or 1-year target on gold be on both the COMEX and the MCX?
Well, Pranay, we were talking about it that inflation is going to be the biggest concern which is going to be impacting prices. So as we mentioned that crude oil prices are going to be consistently in an upward trend, and that's going to add to the inflation. Also, food price inflation globally is going to add to this inflation. So globally, the phenomena of lower inflation is done and dusted, and now gradually we'll see upticks in inflation prices. It's been observed that over the last 10-20 years, data, so inflation and gold generally goes hand in hand. So in case inflation has to go up, it's going to curtail the rate hike cycle to a large extent, and that's going to be beneficial to the gold prices. So talking about that, this guy in North Korea has put his hands on the trigger, and he keeps on switching on and off with whatever he has to do with. So that's kind of adding to the spikes in gold prices, and inflation is going to add consistently to the upward prices. So in my sense, we are headed for another reasonably good uptick in gold prices. Could be about 5 to 7% in the next 3 to 6 months, and eventually about $1,420 and $1,480 is what we are expecting in gold prices over the next couple of years.
Mr. Bambani, would you concur with that thought? And also to add to this, of course, there have been 3 Fed rate hikes. I mean, between last Diwali and now, probably we are staring at one more come the month of December. I mean, would you concur with that view?
I would sort of concur with the view, but my counter argument or hypothesis, if you will, is a little more complicated. Now, if you go back in your financial history, you realize the Southeast Asian currency crisis of 1997 was triggered because of huge amount of debt that these tiger economies had taken on. Number 2, when their currencies kind of collapsed against the US dollar, the debt became unserviceable and also very difficult to repay. Now, the US is the world's largest debtor nation. To be able to manage its debts, it needs a strong dollar. Now, if the US keeps the dollar strong, and remember in commodity markets, it's like a seesaw that you see in a garden. If one child sitting on one end of the seesaw is heavier, it automatically pushes the other child up. So if the dollar is stronger, commodity prices are weaker. And if the dollar is weaker, the commodity prices tend to be stronger. So my guess is the US is going to try heaven and hell to keep the dollar strong, to kind of defend its huge and ballooning debts that it's nursing.
Yeah, because that's interesting. In this year itself, I mean, I think from a high of almost 104, we've slipped to 93, albeit we've seen a brief up move from 91. I mean, and even the fiscal plan there does not seem to hold much water. So do you think it'll be a protracted grind and we could remain on the dollar index at lower levels bounded by 95, possibly on the higher side?
I think so, yes. I think it's very clear that President Donald Trump, once hitting his midterm, would see some amount of enhanced nervousness, which is already being visibly seen at the ground level in the US economy. So if you see enhanced nervousness, I don't see how much or how long can they artificially defend the US greenback. And any signs of cracks in the US greenback automatically benefit the gold prices.
Navneet, very quickly before we go to industrial metals, which is obviously the most interesting piece in the pie, what do you think about silver? And I mean, if you see gold at levels of 1400 the next 2 years from now, do you believe that there's more upside on silver left? And thereby I'm trying to get at the gold-silver ratio as well.
Well, we saw this ratio widening up to 78 at one point in time. Now it's back to about 73, 74 odd levels. In my sense, silver has really underperformed as compared to gold, and predominantly focus has been on gold because gold prices had corrected by about 60% from highs. From $1,920 odd dollars come down to about $1,080. So focus largely also on gold prices, and also globally when dollar index is very choppy, then gold tends to be the flavor of the season. But now that industrial metals have been performing really well, industrial demand for silver and other industrial metals continue to keep on rallying. So beyond the point, aluminium has rallied about 20-30% in the last year or so. Copper has rallied about 40%. So these all metals will become really expensive, and it could be a point in case where you have some kind of substitution coming into these metals for silver, and that is what could lead to a price rally in silver. My bet is I am more bullish on silver as compared to gold, and probably from here on about 20-25% upside could be very much in store.
All right, gentlemen, we're going to take a very quick break. We've already spoken about crude oil as well as gold, but on the other side, we get you the most interesting piece of the commodities universe, that is the base metals and the kind of strong up move that we've seen, what the outlook looks like for the underlying as well as the stocks associated with it. We'll continue our conversation with our guests on the other side of a very short break, so stay tuned.
Bell begins to ring. Stories making headlines, moving markets.
Sensex seems to be trading rather strong.
See some correction in the short term.
Marginal moves being made.
Catch the midday wrap of all the things you need to know.
Buying has been so strong.
Global market also been very benign.
Get a sense of things to come with newsmakers and experts' analysis and insights. Stay ahead with a holistic take on all that matters. Lunch Money.
India of the next 20 years, lots of opportunities will show up.
You want to come to the market to make money, and that is possible only with a focused strategy.
60 to 70% of the returns in India are coming from a global bull market.
Let's speak about the most interesting piece of the pie, and let's start with copper. In fact, almost a 42-43% gain that we've seen since last Diwali. Zinc is up almost 33-34%. There's aluminium, which has seen strong gains of almost 23-24%. Nickel, on the other hand, has been relatively little subdued, 8 to 9% higher. There's palladium, which has also hit its highest level since the year 2001. A lot of factors, and only one discussion probably cannot encapsulate every element here, but we'll try capturing most of it. Mr. Bambani, let me come to you first on Dr. Copper, as you call it. Do you see more upside on the underlying from here on?
I think so, yes. If you allow me to add to what Navneet very intelligently put this on silver. Now, you're looking at electrification. Now, electric vehicles, electric alternate energy from solar power, etc., is the new buzzword in replenishable or renewable energy. You cannot have photovoltaic cells without silver. Now, silver to that extent becomes a electrically critical element, as it has been termed now. The more you go in for electrification, the more you need copper cables to transmit and distribute that power. So, to that extent, higher crude oil prices, which we are expecting, will make renewable energy much more commercially viable. And as it becomes more commercially viable, it is going to fuel the rally in copper itself. So my guess is copper will remain an outperformer, and you're talking about a phenomena called the reflation rally. Now, this reflation rally is going to see copper as being a direct beneficiary.
We've seen good data coming through from China as well. Does that support the thesis that copper, despite these strong gains, will continue gaining from here? Do you see a brief phase of consolidation come through and then the rally resumes?
See, consolidation could always be on store, because something which rallied about 35–40% in a very short span of time could consolidate. So that's something beyond which we should be looking beyond. But yes, in my sense, China has been performing reasonably well over the last 1 year or so. We've seen the corporate earnings of China going about 18–19% by China. So any crackdown there could lead to a negative impact.
Let me come to steel prices as well. I mean, steel prices have remained buoyant, resilient. We are seeing the evidence of that in our corporate earnings as well. But what I'm trying to get at is the cost of steel inputs. I mean, we've seen obviously Australian hard coking coal on back of seasonal factors as well, see huge spurts and act in a volatile fashion. But what do you feel about zinc as well as nickel? Nickel, of course, has been also a victim of the kind of environmental ministry rules that we've seen in Philippines and the outages and the releases from there. But both zinc as well as nickel, I mean, zinc inventory also, LME inventory has also had a part to play in this.
Pranoy, take the case of nickel. Now, the hurricanes that you saw in the US, rising water levels, if you check your global supply, some of the parts kind of equation where nickel is actually coming from, there's this tiny little island called New Caledonia. Now, New Caledonia tends to get submerged underwater whenever the sea levels rise. And unfortunately for mankind, it supplies 24% of world's nickel. Now, in 2012, when the New Caledonian mines were submerged underwater, and remember, it's seawater. So to pump out seawater from a nickel mine and kind of get excavation equipment, get working again, takes months. Now, the more you have natural calamities, the more you're going to see nickel prices becoming patchy. In addition to the Philippines, you also have the Indonesians who are now contributing volatility to the nickel prices and higher nickel prices. Now, nickel was barely 550 or 560 rupees a kilo on the MCX towards the end of June. You're now at 750 rupees, which is a good 38% jump. Now, you cannot make stainless steel without nickel, right? So your input cost for stainless steel is going to go up. Similarly, for zinc, you have some supply side constraints coming in. And if the dollar is to weaken, zinc prices will also go up. So I do think that these are points that every commodity trader, especially a base metals trader, need to factor in. So barring these threats, I would still remain optimistic.
Navneet, if I were to ask you for your pecking order, and I know, I mean, it may be a little early in the day to do so, but from among all these industrial metals, maybe copper or aluminium, zinc, bauxite, or even nickel for that matter, what would your preference list be?
See, aluminum is the flavor of the season for this, because they were talking about winter coming in and probably 30–35% of Chinese capacity going off stream. So now we are approaching winter. So for the next couple of months, we can see aluminum prices maybe stabilizing or maybe inching about 8–10% gains from here on. But that's going to eventually fall off, because new capacities will take about 3 months, 6 months across the globe to come in and probably fill up the gap which China is going to create over the next couple of months. So this rally in aluminum which we're seeing is time bound and could end by the start of the new year. But talking about nickel, as you mentioned, that nickel has seen significant jump, but as compared to other metals is nowhere the kind of movement which we've seen in other metals. So in my sense, if everything is going so perfectly in the world and China is consuming more and more steel, new electric vehicles have to come in, which will be more of steel consuming and more of aluminium consuming as compared to iron ore, and more electrification is happening. So steel demand is eventually going to go up, and that is going to require little bit of more nickel than what people are more consuming at the moment. The Philippines substitution is now kind of curtailed because Indonesia is now contributing to the gap which Philippine guys have created. But in my sense, that's not the picture now. Steel demand as well as more capacity which are not able to come in, and pig iron shutdown is going to be the key to the nickel prices. So anything below 10,000 could be opportunities for a medium term perspective to go along, and from the risk reward point of view, nickel could be the best bet in the base metal pack.
Okay, and probably some element of catch-up also could come through there. Navneet, it's Dhanteras, and of course we cannot let you go without asking you about the initiation of gold options trading on the MCX platform. What kind of an upside do you think it can bring in terms of volumes? Because I understand that quite a few hedge funds have already tied up and expressed interest there. Corporates like Titan also probably could be interested in the same. What do you feel? Your first thoughts?
See, it's a very auspicious occasion, Dhanteras, and somebody who's been in the commodity streams. So this 13 years of consolidation that some new product is coming to commodities. So in my sense, equities volume about 80-85% contribution comes in from options. Gold will not be the only driver for options or option business for commodities, but yes, eventually when more commodities will be launched in, it is going to create a buzzword for MCX, and it's going to add significant volumes.
Mr. Bambani, I mean, it's usually also seen that the kind of beta stocks command over the underlying metal is always 3 to 4 times higher. So we are seeing Hindalco, Vedanta, Nalco, and all these names do exceedingly well. So if I were to put you to the mat and ask you that going ahead for the next year, would you be more bullish on the underlying, or probably do you feel that there could be some upside on the stocks associated with these? Where would you go?
Pranay, where stocks are concerned, I think they have now moved into an area of counter-cyclicality. Whereas the underlying commodity is concerned, I think they are still in the lower band of pro-cyclicality. So the risk-reward ratio seems to indicate that the underlying would have a better chance of giving you higher returns than the stocks itself.
Fair point. For dearth of time, gentlemen, we're going to leave it at that, but appreciate it as always, Mr. Bambani, you joining us in the studio live, and Navneet as well, giving us your thoughts on how the year has been and how auspicious it is, in considering the kind of rally that we've seen on base metals and what the outlook looks like. More importantly, clearly, the bias seems to be in favor of commodities in comparison to equities. Of course, the Nifty has given us 17%, while commodities like copper has given us almost over 40%. So that probably seems to, I mean, the view seems to be that it's likely to continue, but that's all that we have on this special coverage, Markets in Samvat, the commodity special.